In the fall of 2008, the global financial system began to break down. Major banks collapsed, and the public quickly lost confidence in the institutions and politicians tasked with protecting their money. Markets dropped sharply, and the professionals managing these traditional financial intermediaries scrambled to make sense of the chaos unfolding on trading floors worldwide. Right in the middle of this crisis, on October 31st, a white paper appeared on the internet. Authored by a person or group using the pseudonym Satoshi Nakamoto, it proposed a peer-to-peer electronic cash system. A few months later, on January 3, 2009, Satoshi launched the network with 30,000 lines of open-source code. They mined the very first set of data, known as the Genesis block, which created the very first 50 bitcoins. The protocol offered a ledger maintained not by bankers, but by the collective verification of the network itself, relying on strict mathematics to prove the validity of every transaction. This diagram maps the supply schedule programmed into the network. It shows that there will never be more than 21 million bitcoins in existence. The rate at which new coins are created slows down over time, a rule designed to prevent the inflation that happens when central banks print more currency. In those early days, this digital code had no monetary value. It was primarily an experiment, passing back and forth among a small community of cryptography enthusiasts. That changed on May 22, 2010, when a programmer named Laszlo Hanyecz offered 10,000 bitcoins to anyone who would order him 2 pizzas. Someone took him up on it, making those 2 pizzas the first physical goods ever purchased with the cryptocurrency. Based on the asset's peak trading prices, the 10,000 bitcoins used for that single dinner order would eventually be worth hundreds of millions of dollars. That exchange proved the underlying code functioned as a medium of exchange. People agreed it held value, and that mutual agreement turned an abstract digital concept into a functioning asset. The blockchain is a public ledger distributed across thousands of computers, permanently recording transactions into sequential data blocks. To secure this ledger, computers perform a process called mining, expending computing power to guess the solution to complex mathematical algorithms, like SHA-256. When the network first launched, the math puzzles were simple enough that anyone could mine new coins using a standard computer processor in their bedroom. But as the potential profits grew, an arms race began. Miners quickly upgraded to the powerful graphics cards used for video games, and eventually moved on to ASICs, specialized microchips designed to do nothing except solve Bitcoin math problems as fast as possible. Today, solo mining is nearly impossible. The process is dominated by mining pools, operating out of massive, warehouse-sized facilities, packed with hardware running constantly. This scale is required by the code itself. The network is programmed to automatically increase the difficulty of the mathematical puzzles as more computing power comes online, forcing miners into this continuous industrial expansion to maintain their operations. Because the network operated without government oversight and offered a degree of anonymity, it attracted users who wanted to avoid traditional banks. It became the primary currency for illegal online marketplaces like the Silk Road, which facilitated the trade of drugs and weapons. In 2011, right as this ecosystem was expanding, Satoshi Nakamoto stepped away from the project entirely. Their true identity remains unknown, and the network was left to run autonomously. Users needed a way to trade their local currencies for Bitcoin, and a platform called Mt. Gox emerged to fill that gap. At its peak, this single exchange handled roughly 70% of all global Bitcoin trading. Then, in early 2014, Mt. Gox collapsed. It was revealed that the exchange had been compromised by hackers and internal mismanagement, resulting in the loss of nearly 800,000 bitcoins, worth hundreds of millions of dollars. The ensuing media fallout was severe. Financial commentators declared the asset dead, framing it as an unsafe haven for criminals and a failed experiment. But the network itself survived for one specific reason. The underlying math of the blockchain was never breached. The failure rested entirely on a centralized, human-run business, proving exactly why Satoshi designed the core protocol to operate without them. This chart tracks the currency's recovery and subsequent explosions in value. Despite heavy volatility, the price per coin broke $10,000 in 2017, and by early 2021, a single Bitcoin was trading for over $60,000. The demographics of the network shifted. The cypherpunks and hobbyists were joined by massive institutional players as major banks, publicly traded companies, and corporate exchanges began holding and trading the asset. Wall Street adoption accelerated in February 2021 when Elon Musk announced that Tesla had invested $1.5 billion directly into Bitcoin, pushing the price higher and legitimizing the currency for traditional tech investors. Look at this bar chart comparing the network's electricity use. Processing these transactions and solving those math puzzles consumes over 121 terawatt-hours of power annually. That means this digital network uses more electricity than entire nations, like Argentina or the Netherlands. What began as an internet experiment now forces central banks and governments to navigate a financial system that operates outside their direct regulatory control. The lasting innovation of this era is the blockchain itself, the decentralized structure that allows data to be stored and verified without a central authority. Corporations and governments are now attempting to harness that architecture. They are adapting block linking technology to build secure data storage networks, perform transparent financial audits, and track global supply chains. Satoshi Nakamoto successfully demonstrated that a decentralized network, without a CEO or a central server, could operate securely on a global scale. Whether Bitcoin remains the dominant digital asset in the coming decades is an open question, but the network proved that human intermediaries could be replaced by unalterable code, introducing a completely new architecture for digital commerce.